Welcome to Management Decision and Control. Today we want to acquaint ourselves with the topic on pricing decisions and profitability analysis. We know that businesses sell products, and these products are usually sold at certain prices. Now, businesses over time usually try to find what is the best price to give their products. And there are many factors that businesses do, of course, do follow, especially in determining what is the best price of the product, taking into consideration the competition, but also going ahead to look at their life cycle. And by competition, I'm trying to look at the aspect of the competitive prices. For example, if it's MTN that is trying to price a new phone it has brought to the market, I believe one of the things that they will look at are how other companies pricing their phones, or if it's maybe Samsung coming up with a new product, maybe it's a laptop, to be able to look at how are the Dells pricing their products. And not only that, or why I've brought in life cycle is that when it comes to pricing decisions and profitability analysis, businesses usually use what we call price penetration and premium pricing as one of the pricing techniques. And we've seen this especially with new entrants into the market. Usually, those new entrants that want to attract people to buy their products sometimes do price their products at a lower price, and this is penetration kind of pricing, especially where maybe they are competitive products, so they come with a cheaper product because they want to attract a given class of customers, but they also want to appeal to customers and show them that they are of a lower price. And we've seen this with some products, especially in Uganda. For example, when some telecoms joined the market, they brought cheaper calls, and we've also seen it with TV subscription companies when StarTimes came through, when we just had the digitalization of televisions, how StarTime came through and offered a lower price compared to the DSTV offer. So this is very common as well. And of course, very similar, this is the premium pricing. Premium pricing is usually cases where products are actually priced expensively as per se, but the key role here is for the customers to think of the product in a premium manner. We have, in Uganda, we have premium banks, where even just to have an account there, it's only just for premium customers. They make themselves to be premium organizations, but also in the side of products. There are organizations that, or companies that enter into the market with a product, but at a premium price. Now, for penetration pricing, usually it's a low price. For premium pricing, usually it is a high price. High price because they want to attract a given class of clients, but then they also want to ensure that, of course, they're able to recoup their research and development costs, especially what they invested. The intentions could also be to just try to compete on aspects of being able to be perceived of high quality. In TV subscriptions, we know that DSTV has premium packages, which are usually for premium clients. I think we've seen that iPhone as a product, especially in our Ugandan market, is a premium product. and it's only for few people that can actually afford such a product. So some companies come with that premium offer of their product in terms of pricing. So despite how the competition is, they'll come with totally that. And then we now have what we call the cost plus pricing, which is very, very common, especially when it comes to many companies. Usually what happens is for most companies, for them to determine the cost of the product, for them to determine the cost partly is to help them determine the price of the product. This is very common, especially in retail settings, where, for example, you have bought, let's say, let me use an example of a loaf of bread. If a loaf of bread costs, let's say, maybe 800, okay, let me do 4,000. Okay, if a loaf of bread costs 4,000, the seller may proceed to add a margin, and maybe we'll say that my intention is to make maybe a 500 on this kind of bread. And at the end of the day, they go on to price their product at 4,500. So this is that kind of pricing. This is that kind of pricing when it comes to cost plus pricing. So cost plus pricing involves accumulating the cost of providing a service or providing a product and adding a markup or margin. I believe that right now you are aware of what a margin is and what a markup is. Usually when we say margin, here we're trying to look at it from the perspective of sales, because margin is usually given by the gross profit divided by the sales, if you're trying to look at it from the perspective of percentage. But you can also be able to get the absolute value as well. Then markup is usually gross profit out of your so-called cost of sales, which is the cost of the product. So yours is to understand that there are various decisions that are actually embedded with when it comes to how organizations price. Now, one of the most common ones, like, because I spoke about life cycle here, is it is really dependent on one of the factors that you need to take into consideration is where you are as a business within the life cycle. And whenever I speak about life cycle, especially for our study, yours is to understand that life cycle of a product looks at aspects of introduction, of course, introduction into the market, and introduction moves to growth, moves to maturity, and moves to decline. So life cycle costing or pricing is trying to have an understanding of where is our product. Has it just been introduced? Now, why this is very important is this life cycle model is dependent also on your demand. And what I mean by this is that when introducing your product, you're actually growing your demand. You're trying to grow your sales. You're trying to attract people to your product. That is one of your intentions. But as you proceed with growth, many people have adopted to the product, and you're now starting to see yourself, your revenues are increasing, and you're somewhere into breaking even. Now, usually at maturity stage, this is a stage at which there's that satisfaction has reached that satiety stage. And here we're trying to look at a stage where people have consumed your product. I'll give an example of that really depicts this, is that if you've you have watched the journey of how mobile money has grown from the time when mobile money was introduced and where people were a bit curious to understand, is our money safe? If I'm reposting my 500,000, another person is just receiving a message, how does it really work? We had that stage, and progressively we saw that people started appreciating mobile money, and that is a time where just having being an agent of mobile money was a killer kind of business. It was a business that would give you good amounts of money. And as time goes on, as we see competition coming in, especially maybe from other telecom companies, but also from alternative ways of, let's say, sending and receiving money, where we have seen the agent banking coming in, and then we're seeing some level of maturity for such a kind of product. And we are seeing that as this product, yes, for some, they may judge it from the perspective of maturity, but you see that it's reaching at an extent where the telecom companies have now to find ways of how to remain relevant and to maintain the customer base that they have grown over and over time. So very important. Now you see that if it's introduction, you're attracting people and you want to deploy things like price penetration, where the rates are very low, let's say withdrawal charges for mobile money services. And as you grow, the demand is high. So at that point in time, the response to demand, the response on the side of demand due to changes on price is a bit low. Because people are you already have huge demand. People are already tapped in there. So it's very important that you understand this life cycle and how it may influence your pricing decisions. And for example, if when a product gets to decline, this is a point in time where you have stiff competition around, and either your customers have now moved to alternative products, and you have to ensure that you remain relevant. You may need to rebrand yourself, or even lower the prices of your products, cut them so that you can be able to attract good amounts of less in terms of numbers, in terms of customers. So that is very, very important, especially when it comes to the aspect of pricing. Now, given that that is a background, I also just want to comment about the aspect of profitability analysis, because pricing decisions and profitability analysis, some or the other, work together, the journey. Now, profitability analysis is one of those terms that is very common, especially in companies that deal in several products. A case in example, if a product, if a company is dealing, let's say, in product A, and maybe let's say, let's use a still maybe an example of let's say MTN. So it is dealing in product A, which could be data, and then maybe it's dealing in another product, let's say B, which could be maybe calls, and maybe product C, which is text, and so on, and maybe product D, which could be data. Now, over time, businesses usually want to understand which of our products is actually making more money. So that's the first aspect of profitability analysis. Which one of our products is actually making more money? Not only that, businesses are trying to find out which one of our products, let's say, is able to generate more money, let's say, per customer. Now, the aspect of per customer, how it comes in is that although we have product, let's say product D, which is data and maybe product A, mobile money, and so on, whatever kind of products you have. Under here, you have also different customers. You have customer 1, customer 2, customer 3, customer 4, customer maybe 7. Maybe these are just respective coding for these respective customers. Now, one customer is able to give you a revenue of let's say 600,000, and customer B is giving you 7 million. Okay, customer 3 is giving you, let's say, just 40,000, and for customer 4, maybe customer 4 is giving you 100,000, because you have different classes of customers. Now, in servicing these customers, you also incur costs. Maybe this is this in terms of revenue that comes from here. And in servicing these customers, you incur costs. And you may find that the cost of servicing maybe a customer who gives 600 maybe could stand at, let's say 400,000. And this is could be any other business. Maybe servicing this other customer, maybe this could cost you let's say 6 million. And servicing this one is costing you 100,000. And maybe servicing this customer is costing you maybe about, let's say, 150,000. Now, why am I bringing this aspect is that businesses, although serve different customers, they may find themselves incurring huge costs on the customers, let's say, that are buying little. I'll give you an example. If you're Jumia, say for Jumia that offer that you have to pay for your delivery cost. But if you're Jumia and the customer was paying, you were actually paying delivery cost for the customer, and you have to deliver a product of 40K to Karamoja, and you have to incur bus costs and all delivery costs, and this customer, you have to spend over 100,000, let's say, to serve such a customer. So your interest will now move to customers where you know that this customer buys huge, and even if I'm put a delivery truck, I'm able to make a net income out of this customer. And businesses now move from just servicing customers that have a low profitability, because at the end of the day, what businesses are now going to look at is how much are we able to make from each of our customers in terms of profit. And you can see that for cases of where you're making negatives, then businesses have to rethink and say, are these customers worthy our time and effort? And that is why you see for some businesses, I'll give you an example, like I think Citibank, they have a certain class of customers they do serve. You'll not see such banks coming to, let's say, following you up to either take a loan or following you up to just have an account as an individual, because they have tried to look at their business model and they feel they're better off serving maybe customers that are able to give them more revenue than just individual customers. So why this is very important, of course, it relieves businesses of being able to continue in the cycle of serving customers that are not profitable. And in this era of data, where you can easily get data on how each of your customers is able to bring in, because you can easily track all those costs around the customer. For example, if it's MTN has your phone number and it's able to look at how much data you have loaded in a month and how much costs maybe it has incurred. And that is why you see that even when you say you're making calls, especially for customer care to such entities. Sometimes the attention, sometimes because your number is mapped as a low profitable customer, maybe it may them even take time to pick you up, and they want to prioritize customers that are actually able to take more, and that means businesses are able to make more from them. So very important to understand the aspect of profitability analysis and pricing as a key aspect for us as management accountants. And again, like I usually say that the reason why we study these concepts is that we are the guys, the so-called management accountants that provide management with data, with information to help it make key decisions. So us understanding how businesses are able to think about different aspects like cost, like life cycle, and how all those might influence decisions, especially around pricing. I think it's very, very key for us to know. Okay, so that is very important. So these are just resources for to help us understand more on how businesses can actually go to make decisions. So accounting information is very, very key, especially in setting decisions, pricing decisions, because businesses are trying to use either previous information or even current information. Because if you have incurred raw materials of a certain value, you've incurred labor cost of a given value, then you can easily inform management on how much is the cost and what could be the price, that is suitable. So we come in very, very key, especially in this aspect of being able to provide the right information for management to make pricing decisions. So they're able to come up with an optimal price that is able to cover usually several factors. And of course, there is no designated, say, this is the best method to use when it comes to pricing. But one of the things that I've experienced, especially in the professional world, is that businesses will take all due consideration, look at the competition, will look at the cost to see, because you see, you may find that another business is charging, let's say, 1,000 for its bottle of water. But you as a business, you actually incur 1,500 to produce the same kind of water. So you cannot just base on the market price, but also get down into what are your costs, okay? And how is your demand, okay? And so on. So all that comes to how we look at that. Of course, with the market and supply being very, very key to understand. I think we've seen this, especially maybe the transport sector, where during the festive season, the prices are different. During the other seasons, the prices are also different, because these ones have even taken into consideration to understand how is the demand. If the demand is high, we can set our prices high. If our, let's say, the supply is low in terms of, let's say, available options, the customer has no option but to even pay a higher price. So important on that aspect. So you'll be able to go through this. This is just a demonstration. This is more of like a demand curve to just show how price is able to influence quantity. Of course, we can't just we can't just leave it at it from the perspective of setting the price. We also need to understand and say what happens, because today you may not just be setting a fresh price, but the business may be interested in increasing the price of the products, maybe due to hard economic times like the ones that we are in right now, where businesses want to revisit their prices. It's very important for businesses to look at also the aspect of how does the increment in price affects demand? And that's where the demand curve comes in. And as you can see, if we have our price A, let's say if our price is, let's say, at price A where it's high, if you see that your demand is 2A, so it's a way bit low. And when you look at let's say price B, which is a bit low, that is giving you quantity B. But economics also teaches us that not every product has the same level of price elasticity of demand. Why? Because products like necessities, they act a bit differently when it comes to how they respond to prices. Such products, even if prices do increase, you see that the demand may not be affected. And for products that are luxury nature, you may find that this is actually different based on how these relate to how the demand curve may look like in case their price changes. So it's very important that as you provide information to the decision makers around pricing, you also understand the elasticity of demand for your products, okay? And this is what we tried to illustrate here. So this demonstration right here is also giving us how we be able to establish an optimal price. Now, an optimal price, we're trying to look at what is, let's say, what is our revenue, okay? What is our revenue for each of the units? As you can see here, benchmarking on how our demand curve looks like. When units, when the price is 40, you see that we have 100 in terms of units that are being consumed. And when our price goes 3,800, we are seeing that this demand increases because the price has lowered down. When the price even goes lower, we are seeing that we have 120, which is again more demand. And we see that this keeps on changing. As you can see, as the price keeps on going down, we see that the demand also keeps on increasing. And we have the total revenue for each of the increments for each of the deductions in price and the increments in demand. And then we have our marginal revenue. Now, marginal revenue is usually additional revenue for extra units sold. So as you can see, our marginal revenue here, if you get the 4 million and subtract it from the 180, you have your marginal revenue of 180. So this keeps on increasing. But I just want you to look at something here. When you get to this level, you can see that when our price is 30,000, we have 150 units that are demanded. When the price reduces by 2,000, we think that we get 160 demanded. Now, when you try to look at this marginal revenue, because this is 4.5, and when you get your 2,800, the 28,000, and multiply it by 160, you get 4,480. So you're getting a negative. So although businesses are so much interested in, let's say, maybe better demand, higher demand, and they continuously lower their prices, they need to understand that there's a level at which, below which, the marginal revenue will actually be negative. And that's actually what's that we are trying to see there. That is what to see there. So for businesses to establish what could be now, given these results, what could be the optimal selling price that we need to sell at now? The optimal selling price is usually the price at which we maximize profits, because definitely businesses do exist to make profits. So that price at which we maximize our profits, that is what we would call the optimum price. Now, the information here in this table here provides us mostly information on revenue. But ours is ask ourselves, what if we now look at it from the perspective of costs? What would be our optimal price? So as you can see, table 2 now goes on to pick the same information, as you can see, price and our so-called the respective demand. So then we're now trying to look at it from the perspective of our total costs. These are basically estimated figures, but as you can see, we're seeing that this keeps on changing as well. This keeps on changing. For example, when you look at, as you can see, of course, one of the things that you need to know with revenue, revenue is growing. As we go down here, revenue kept on growing, okay? So we want to understand what happens exactly with our costs. Of course, as you increase units, because usually costs are directly, okay, they are directly, in terms of proportionality, the higher the units, the higher the cost. Why? Because we have a variable cost per unit in part of our total cost, because total cost is variable costs plus fixed costs, and the variable costs is usually variable cost per unit times the quantity. So when you see how our information here is moving, and this is just an example, you see that as our units keep on growing, as we grow from 100 to 110, 120 to 130, we also see an increment in the cost. Okay, just as we saw up here when it came to revenue, although we got to a point in time where the revenue started dropping. Okay, so as you can see, if we have these levels and we have these respective costs, the marginal cost, you can see it keeps on increasing. So what we are saying is, in this case, if we remember, we said that the optimal price will be at that level where our profits will be maximized. So what that means is that we have to go on to calculate our profit. So if this is our revenue, 4 million, and we have our cost 3.6, what would be our profit? Because profit is total revenue minus total cost. So we have this table, which is looking at total revenue, total cost, and we're able to determine our profit at hand. So if we have our price, this, you can see the respective cost. So you can see this profit. I want you to just study this profit and see how it keeps on changing. So you can see at 40,000 price, we have 400, and this keeps on increasing, 640. This is profit. And when you come to 640 here, this seems to be our highest. This seems to be our highest, because after this, we actually start dropping. We start dropping. When you come down, you start to see that our profit will keep on reducing. Now, why businesses are basically into business is basically generate profit. So if we were to determine what would be our optimal price here, it's very clear that the 34,000 comes out very clearly, that for such a business we need to do to take on the 34,000, because at this level is when we maximize our revenue. So this is one way to be able to determine a price of a product. Of course, this has limitations to it, because you need to have information available. especially on the prices at different levels of demand. You need to be able to predict that, which is not very easy for anyone to be able to predict. Like, it's not any layman's way. So you need to be able to involve different estimates and assumptions to be able to come to that. So this same optimal pricing can also be done using differential calculus. I don't know if you I know that some of you are already mathematicians here. Maybe you studied mathematics, but differential calculus, what we are trying to basically do is we are trying to determine our so-called, you can call it profit function. Okay, our goal is to get our profit function and then go on to differentiate it accordingly. Now, one of the things that you need to understand is at optimal level, usually MC is equal to MR. And what MC is that this is marginal cost and marginal revenue. Okay, marginal cost and marginal revenue. Now we've understood what marginal cost, what marginal revenue is, and we can also appreciate what marginal revenue could be as well. As we saw here, I don't know if you want to see, just so this is marginal cost. As we saw, whenever this increased, it was just the difference. So marginal cost is the additional cost that is incurred with production of more units, usually sometimes this can also go to per unit as well. Okay, but this is just the word marginal is also, you can call it additional. Okay, it's basically additional. So that is very important, and that was very the same thing also that we are talking about when it comes to revenue. It's also additional revenue. Okay, so the principle is that at our so-called optimal level, the optimal pricing level, your marginal cost is usually equal to MR. I could be able to, if you've seen, could be able to just demonstrate something small here for you for this specifically. Before that, like, we just try to read through this example so that I could just be able to highlight the same before I just demonstrate to you. So just look at this example where they are saying that one division of ABC Limited sells digital products, and they're giving us fixed costs of 700,000 units, 700,000 shillings, sorry. They're giving us variable cost per unit of 70 shillings per unit. They have also given us the selling price. They're saying the current selling price for the product is 160 shillings. And at this price, they normally sell 10,000 units. So they're telling you that this current price, they sell 10,000 units are demanded. They're saying the management accountant has been able to establish over time for each consecutive increase in price by 2 shillings, and your demand will fall by 500 units. So every time, let's say our current price is, let's say 160, and it increases by, let's say 2 shillings, we're going to see demand falling by 500. So maybe this would be 9,500. Okay, and this is exactly how these tables are created. Now, in this case, we're going to use calculus, but just in case your examiner expects you to do tables like this, they will give you similar information. where they're able to give you what happens when demand increases. Or when the price increases, how does that affect the demand? And then you from there, you're able to construct a table to depict how marginal revenue can be and how the marginal cost can also be. Okay, so that is very important. So they are telling us that calculate the optimal price for the product, assuming that if the prices are set within a range of two shillings each, there will be a proportionate change in demand. There will be a proportionate change in demand. Now, for this kind of question, especially if you're using calculus, one of our goals is usually to make equations from the information provided. So as you can see here, they have given us our so-called fixed costs. And we also have our so-called variable cost per unit. Now, from that, we can be able to create our so-called cost equation. You remember what we said when it comes to our cost equation? We say that total cost is usually given by, and say total variable costs plus total fixed costs. So and this same formula, of course, can be broken down now into, if we are trying to now to write equations, we can go on to say that where we have the variable costs, this is going to be V, which is basically the variable cost per unit times the quantity at hand. And then this fixed cost, of course, is usually represented by the word by the initials FC. So that is what we basically have. So from this question here at hand, we should be able to substitute the 770 shillings. And as we substitute it, you get to realize that our formula will now be total cost equaling to the 700,000 plus 72, because 70 is the so-called variable cost per unit. So this is how your total cost equation will actually come up, where Q in this case is actually the demand, and we are trying to look at annual demand since this is total cost equation. Okay, so this is what you basically have. So what we also need to look at is, this is giving us the total cost. Okay, this is giving us the total cost, but then we also need to look at now what could be our so-called, let's say, demand equation. Okay, what could be our so-called demand equation? Now, they have given us what exactly happens. I just want to demonstrate something small here. Sorry, my Excel is frozen. Okay, maybe it's getting a little better. Okay. What I was saying is that I just want us to see how we can be able to create a price function. and my Excel was just trying to freeze. So we're going to look at what is the demand at the different levels of prices. So price. Let me just try to close and then reopen. Okay. Just trying to restart my okay, as I try to restart my Excel, what I was going to say is that we can try to look at the different levels of demand from the information they have given us to be able to come up with that equation of one that has price in it. So it's just taking long. Just share this question too. So I'm sharing with you the these notes that I'm using on the WhatsApp group so that you can be able to look at the question. Just share it in the WhatsApp group. In case you're not in WhatsApp group, you can try to let me know and I can be able to add you. Let me just drop them there. So I've shared the notes as my Excel opens for you to be able to just see. Okay. So I was trying to, I wanted to give you how we are going to look at the demand function. So we have our so-called products, and we have price and quantity. So they're telling us that at 160, the demand for our products is 10,000 units. It's 10,000 units. Okay. And they're telling us that for every fall in demand, for every fall in our price by 2 shillings, we just get this directly. So we are reading the same thing, but I was just shared with you. So they're telling us that the management account has been able to establish that over time, for each consecutive increase in price by 2, so increase in price by 2 leads to a decrease in demand by 500. I think, yeah, a fall in demand by 500. By 500. So it means that this would be, let's say, 10,000 500, so about 9,500. Okay, and you can be able to go on and over on like this. So we know very well that price influences the demand. So the demand is, quantity is dependent on the price. Okay, now you know our standard form, our standard equation, which is y is equal to mx plus c, where m is the gradient of our function. This is again some mathematics here, but we'll be able to appreciate. And usually our gradient m is usually given by a change. The change in y over a change in x. And then one of us remember this, and just try to type in the chat box if you remember these terms, so that I know that I'm only not speaking to myself. So do we know what gradient is? Okay, we shall learn. Change in y, change in x. So for price, for this case, our y is the price. And this means that it will be 160 minus 162. Sorry. 162, since it's what is after. And then this will be 9,500. We don't just choose the highest, but we're trying to look at these points and then these points. Okay. And what this would be was 162 minus 160 gives you 2. And then this is 9,500 minus this basically gives you this, okay? And when you try to do this, divide by this, gives you this magnitude, the 0.04. So how do you substitute that within your equation? Remember, this is calculus, so we are bringing in functions in here. So you can be able to say, remember your Y is now your P. Y is price. Y is price, which we shall represent by P. Well, X, which is the dependent factor, in this case will be Q, is basically our quantity, which we shall represent by Q. So what this means is that we are going to substitute. So our price P, okay, we are just trying to substitute in this formula of Y mx plus C, okay? Now this C, okay, let's just try to substitute here. We have our P equaling to, now our mx here, our m is now, I don't know if you see that it's a negative. Our m is a negative, okay? Our m is a negative, as we can see it there. So negative 0.04 times Q, okay? Because that is the quantity that we have. That is our Q. And then plus C, okay? Now C is usually a constant. Are we on the same page up to there? The direction we are. Okay. Okay, somebody says yes. So if we on the same page, okay? Now here we have to determine what is our C, okay? What is our C? Now, one thing that you need to know, if you have a function of Y is equal to mx plus C, at x is equal to 0, y is equal to C. So what am I trying to bring in here is that in our case, C is usually is like a price at which our quantity is 0. So like what is at that price where we don't have demand? Okay, that is basically what we are trying to do. And if we have this information, we can actually be able to determine our so-called C. Okay, we can be able to determine our so-called C, because if you substitute this into this function here, which same function you say this can be represented by P is equal to M2 plus C. Okay, so let me do for the first coordinates. So for the first coordinates, this function will be like 160 is equal to 10,000 times my M which my M we've been able to get negative 0.04 plus the constant, okay, plus the constant. So when you try to calculate this, because this will be 160 equaling to this 10,000 times 0.004 gives you about 40, hopefully. I can just try to test that here. You can try it on your calculator. But this gives me negative 40. So negative 40 plus C. So you're going to get your C equaling to 200. Because the negative 40 will cross this other side to make 200. And that will give you a C. So what does that will mean is that my function where I have P minus 0.0 plus C, my C will now be 200. So I can just have the same function and add 200. So this is my equation for here. Now I want you to, I just want us to remember, just trying to show you how we came up with these results here. So as this is our equation, which we've gotten, okay, and we've gotten also, we've been able to compute this, the P is equal to 200 minus 0.042, which is now easier for you, which we've been able to do the computation, okay? So what do we do exactly, okay? What do we do exactly? Of course, this comes out very clearly, but this is what I want you to look at. So we have this as our total cost function, okay? And this is also our price function. Now, why we go on to calculate our price function, I just want to take you back onto something here, because I know that you do remember this. You remember that profit is usually given by total revenue minus total costs, okay? Now, remember, we're trying to look for optimal price. We're trying to look at for optimal price. Now, optimal price, we are saying the marginal revenue should equal to marginal cost, okay? That is one condition we have said. So what that means is that if you have this function, now one of the things that you also need to know is that if this is actually true, that marginal revenue is equal to marginal cost, what happens to the profit? Because, or what happens, what we would call your marginal profit. If your marginal cost is equal to the marginal revenue, your marginal cost will actually be 0. your marginal profit will actually be zero, because marginal profit is just a difference between marginal revenue and marginal cost. So marginal profit will be zero. Okay. Now, how do we determine marginal revenue? How do we determine marginal revenue using calculus? Is we differentiate the revenue function. We differentiate the revenue function. Okay. And what we are going to do with that, with differentiating our revenue function, is we bring in the dy dx. So we are going to do a dy dx of our total revenue function. Okay, differentiating our total revenue function. The same thing also happens with our marginal cost. We just try to differentiate our total cost function. Now, we know our cost function, and we already did our cost function here. I think we got our cost function. Okay, we already have it. You already have it, which was, let me just try to write it. So for cost function, we already got it, and I showed you how to get it. So I'll just put it there. So that's our total cost function, okay, which is derived so much from the total variable cost plus total fixed cost, and coming up with this. So if you ever want to determine your marginal cost, you would have to depreciate this value. Okay, this is what you want to depreciate. And if it's revenue, now revenue, remember, does revenue have a function? Revenue is given by this. Revenue is given by price times quantity. That is revenue. And in simple terms, our TR is given by P times Q, price times quantity. Okay. Now we have quantity. Our question is, what is the price function? So it is from this that we now bring our so-called what? We come and bring the price, because price is now given back. This is the price function. Price is given by that. So where there is price, you'll see us trying to put this, replace it by that. So this will actually be our revenue function. Total revenue is given by this. Okay. So here, if you're trying to get your total revenue, will be negative 0.004 Q plus 200 Q squared. Okay, it is basically 2Q squared. Okay, I'll just use that sign for you to know. So this is how our revenue function looks like. And this is the importance of us first calculating all this that we've just gone through to come to this equation. So if you have this total revenue, then you can be able to determine your marginal revenue, which will be given by DDX of your marginal revenue, which of your total revenue, that which I've done that. So you now have these two functions. You have the marginal cost and this. Okay. Okay. Sorry, this is 2. The squared is here. I think we had, yeah. The squared is on this. Why? Because when you multiply negative 0.0042 times 2, you get 0.0042 squared, plus 200 times 2, you get 202. Thanks so much for that highlight. So let's first look at the marginal cost and now go on to depreciate it. Now, not depreciate it, but differentiate it. Now, depreciation, when we are trying to do the YDX of this, we have a rule, okay? We have a rule of where we do look at the power, okay? I'll just try to just show you here that we can save time. So this is what we've just gotten. Let me just try to show it for you in Excel. So when you are differentiating, we look at the power, okay? And we have that if it's the standard rule is if you're doing the Y, the X of X power N. Okay, if you're differentiating a function of X power N, then that function, when after differentiating it, will be given by N X power N minus 1. Okay, so what that means is that in this case, our X is 2, okay? So wherever you see 2, that is what happens. So we have 700. Now this 700 does not have any 2 on it. So it means that it has a 2. It basically has a 2 power 0, okay? This 700 that we have is more like this. There is a 2 power 0 that we cannot see. Remember, we said that any number to power 0 is 1. So there is a 2 power 0 that we cannot see on this. So when you subject this to this differentiating, means that you're going to have 0 being multiplied by 700,000 and to be 2 0 minus 1, okay, plus 70. Now the power, this is power 1, the 2 is power 1, so you're basically bringing 1 times the 70, and 2 will the power 1 will be 1 minus 1. That is actually what we do have, okay? So at the end of the day, this 0 times 700,000 2 power N power 0 minus 1 will give you 0, because the number times 0 is 0. And we shall remain with only 1 times 70 power 2, 1 minus 1. So we end up with getting only 70 as our so-called marginal cost. Our marginal cost is 70, and you've seen that this 70 is very similar to our so-called variable cost per unit. Is very common, is very similar to our variable cost per unit. So you can see that variable cost per unit is actually the same as the marginal cost, okay? Let's just see how the marginal revenue would be. I want you to watch very critically in case differentiation is not your, it's not something that is very friendly to you. So this has a power 2. So what we're going to do is this. I'm going to have negative 0.004 Q. Now this, I have to multiply it by 2. So 2 times negative 0.004 Q. Remember, it has a power 2, so it's 2 minus 1. Definitely is going to give me just Q power 1, okay? My 200, what will happen to this 200 as power 1? It will be 1 times 200 Q 1 minus 1, like that. So at the end of the day, I'm going to get minus 0.08, I think so, Q plus, now, as you can see, 1 minus 1 is basically 0. So Q power 0 is 1. So I'm only going to remain with 200. So this is what I'm going to have, sorry. So I'm going to have 200 minus 0.082. That is what I'm going to have as per that. Okay. So what means is I would say at optimal price, MR is equal to MC. So what this means is I'm going to say 200 minus 0.082 is actually equal to 70. So I can be able to get my Q to be, okay. I'll bring 70 this side and take the 0.08 this other side. So I'll have 0.08 Q. I don't want to lose the points. I think this is should have a 0 on it. Even this has a 0. So this will equal to 200 minus 70, like that. Okay. And from there, our Q will be given by 200 minus 70 is 130 divided by 0.008. If I want to determine that, I'll come here, press my calculator, and I get 16,250. So what I've gotten is actually quantity at optimal price. Quantity at optimal price, which is given by which we are getting as 16,250. Now, because the question required us to determine price, optimal price, you just come to your price equation. Remember what we had gotten as our price equation. Our price equation is this, and substitute. So our price equation is this. So when you substitute, you have 0.04 times what we have, 16,250 plus 200. Okay. And when you try to calculate this, this will give you 135. Okay. So what this means is that for this organization, their optimal levels of the optimal price at which they can sell is 135. So it comes in here. Okay, it comes in here. So this gives us a good introduction into the topic. And there are several things here that you're going to be able to appreciate. Some of them we've been able to speak about them, especially on pricing, price setting, and things to do with premium pricing, pricing for custom products. I want you to go through these notes, and then we can have another session that can be able. This is cost plus pricing that I've been talking about, where you get the cost and then add the markup. Okay. And then I talked about, okay, you'll be able to appreciate the advantages and disadvantages as well. And then we have the marginal cost. You now understand marginal cost, okay? Because we say that marginal cost is the additional cost for producing additional units. Now, for some products, instead of them looking at the overall total cost, their concentration might be only just on the marginal cost. And this is usually, for example, I'll give you an example. If I was pricing this class based on marginal cost, means that let's say the first student will pay 200,000. Okay. Maybe the second student, I'll look at what is the additional cost for bringing in this student. And maybe this new student, since I already have one student, I'm already incurring some fixed costs in terms of maybe a subscription or for the class where I'm teaching from. I'll now just look at the additional costs. How much is it going to cost me to teach this extra student? Because I already have the Zoom account. I don't have to subscribe to a new Zoom account for each student. So this new student is coming in. How much am I going to incur for me to deliver the training to them? So based on that, I'm able to determine the cost, the additional cost, and it is on that I add a margin, I add a mark